And then, yeah, please, as people join, just welcome into the room. Thank you, everyone, for coming today. It's still, according to my clock, it's still 15:59. So I'm going to wait a couple more minutes for if anyone else joins us. And then we'll aim to get started around kind of 3 or 4 minutes past. So if you don't mind just holding on a couple more minutes, and then we'll start shortly. Thank you. Just while we wait, I'm also going to put my, excuse me, I'm going to put my email in the chat, and I'll also put the email of my colleague Zile. If there is any questions that we don't get to today that you'd like answered, please feel free to drop me an email, and then I can hopefully try to get you an answer. So I'll just be dropping my my email in the chat. It's just past 4 o'clock, so we're gonna kick off. Firstly, I'd like to welcome everyone who's joined us, and anyone who's watching live. I think I'm really excited today. I think this is going to be a really interesting conversation, and we're talking, as hopefully you know, about the Middle East funding landscape. Astrolabs, we are a co-working and licensing community in the heart of Dubai. We have an incredible community of entrepreneurs and businesses at really every stage of development. We have very early business setups, and all the way to some of our members who have closed multi-million-dollar rounds. And the question that comes up so often is about funding. And in this session today, we're going to be considering particularly the kind of lower end of the funding. So we won't be considering the kind of Series A, Series B funding landscape, which is a really exciting landscape, and we may do a future webinar on that. But what we're looking at is really those kind of the initial funding situations where you may be raising anything up to $1 million US. I'm so pleased to be joined with 2 of our members today. Both come with incredible experiences from slightly different angles in the funding environment. I'm going to let them introduce themselves. And then what we're going to do is there's a couple of questions where we're going to speak to as a panel, and then we're really going to open up the floor for questions. In the meantime, if you do have any questions, please feel free to add them to the chat, and I'll try to add them and take them as we go along and interject. And if we haven't got to any, we'll try to answer them at the end. So yeah, welcome and thank you for joining us. And I'm going to ask Kareem to introduce himself first.
Hi, thanks, Kiro. So my name is Kareem Dukkhi, and I'm a fellow entrepreneur. I'm currently advising. I'm building my own startup in the healthcare sector, as well as advising and acting as a VP of Finance on a couple of startups and scale-ups in the region. My background is I come from a private equity background. And as part of my previous private equity experience, I had the privilege to be the co-founder of a company, telecom company in Asia, that has grown to a $700 million company and is being sold actually tomorrow. So it's going to be a great news. And since then, I decided to focus my effort and energy in helping startups and in looking at my next potential challenge. Happy to be here.
Exciting. Hopefully that's not confidential news about the sale tomorrow.
No, it's public actually. They have made announcements already.
Good to know. And Anisha.
Yeah, thank you for having me here. It's really nice to be here to be able to talk about our journey. Actually, like Kareem, my background previously was in private equity as well. I left that field in 2018 and started the journey of bringing Spotty to life in 2019. For the first couple of years, we were bootstrapped, funded by myself and my co-founder. But then we started to look at seed capital or early stage capital as in January of 2020. And we were able to close around come July. And we can talk a little bit more about that experience. But as Cairo laid the groundwork, this call really is about funding and that environment. Um, it's been a unique year, 2020, obviously, with respect to whether it's been with investors or it's been with new business models evolving. And I think there will be some exciting businesses that will be coming out of this, out of what we've experienced this year. And so there are a lot of good businesses looking out there for funding, and hopefully I can contribute to the audience here in terms of my experience.
Exciting. I'm sure you can. I mean, to start with, what does and maybe we'll continue with you, Anusha. What does the funding landscape look like? I mean, how big is it? How rich is it? Any kind of, you know, I'd be interested in your thoughts.
So in that very early stage, I think there's a long way for this ecosystem to go to develop, particularly in very early stage. There were a lot of conversations that I had where it was, show us traction or show us X amount of customers, etc. And as you know, you need certain amount of capital to get to that stage. And it was almost a lot of those conversations were with people who you would classify as closer to a Series A, right? So I think my personal take, my view is that the ecosystem and you said, you know, is how rich is it? I don't actually think it's very rich. I don't think that it's very deep. It's on that early stage, that seed to pre-Series A element. A lot of the initial funds that were playing in that space have now grown out of it. They've got larger funds. They have to deploy more capital, and I still feel like they've left a bit of a vacancy there. Some of it gets filled with high net worth individuals, or some of it gets filled with family offices who are now looking to get into that space. And I think with some of the successes that the VC industry generally seen in the region, you get a lot of people coming in, but then the issue becomes they're not very institutionalized in their approach, and they're not very, so you're sort of educating yourself as new founders while you're educating the institution as well in terms of where you're getting the capital from. So short answer is that it is not that I think it can definitely get a lot deeper. I think there's some very good businesses that are coming up. I come across so many founders who are always looking for capital, and they seem to be having the same issue, is that, everybody I speak to says, show me X amount of traction, which is fine, which is fair. But then is that really seed at that stage when you've already grown to a certain point, right? And so I think getting an understanding of what is at risk at that seed stage, how do you actually raise it? I think there's still a lot of work that can be done. Sorry, that's just my opinion. And I don't know if Kareem wants to add to that, or if he's had different experiences in that.
Sure, it's very interesting, and it's a common point. So perhaps I would like to step back and mention that when I came in the region, it was just after my MBA in 2007. And at that point in time, I remember very well, e-commerce was at its infancy. I remember there were one or two groups that were really specialized in e-commerce, Al Jaber Internet Group. When you wanted a payment gateway, the prices to connect were horrific. They were asking for a huge amount of guarantee that needed to be deposited to get access to a payment gateway. It was very difficult to access to those services. So in essence, it was almost non-existent. If we look at some of the numbers, back in 2009, we had $15 million of investments in venture capital that were distributed over five deals. Fast forward in 2019, that number jumped to 700 million for 600 deals. So as a matter of fact, the ecosystem has grown up and has done quite a bit, quite rapidly. And we see an increase in appetite for investment, etc. So both in terms of deals, in terms of deal size and deal volume, all metrics are growing and all metrics are green. Now, back to what Anusha is saying is that, is it enough? Is it enough? Is there enough capital for the startups in the region? And the answer is clearly not. There is a gap between supply and demand, between funding and startups. And that gap actually is even further exacerbated by perhaps a lack of understanding of what the investors are looking at and when it's the right time to go and see investors. So, yeah.
I think it's interesting. One of the is talk about both here at Ash Labs, but back in the UK is credibility. You know, what investors want to see is credibility, and that credibility can come through, you know, revenue and growing, and you know, you've delivered. It can come through the founders being credible in their own right, as you know, maybe successfully funding other organizations. And I think one of the things interesting in this region is we haven't had that many unicorns that have grown out from it. So I wonder if because the kind of startup world here is still developing and they're growing, that as kind of, you know, it may be a time factor as time progresses, you see more and more of these startups being successful, that actually there may be a move back to kind of pre-revenue investment and away from the kind of, you know, asking for significant traction. And then do you have any, just as a quick aside, in terms of accessing these funders? I mean, I think Kareem, you had a really interesting point about knowing the right time to go to the investor, and actually getting those meetings, getting those questions. I suppose it kind of comes to my second question, like what should founders be doing even before they get to, you know, trying to have a conversation with an investor?
Look, this is part of exactly the consulting services that usually startups come and ask me for, because you know, going into the markets to raise funds, you know, I think there is, it's mainly, I think, when you are a first-time entrepreneur, I think there is some sort of innocence or naive impression that, wow, I have this amazing idea and people are going to be like running after me to invest. Okay, well, it's good to be enthusiastic, but the reality doesn't work this way. And having a great idea is a starting point, but it's not a success factor in any way, shape, or form in entrepreneurship. And I think when we sort of really understand this, we start, you know, we need to step back as a founder and say, okay, what do I need to do to get myself ready? And when is the right time for me to go to the market? So not only there are for me, there are two questions. First is, am I ready? Is it the right time for me to be presentable to the investors? And if so, have I done the right preparation to actually meet the investor? And for me, these are two different questions. And my answers is as follows. For the first one, which is it the right time to go and see investors? This is linked to what Anusha mentioned, related to, okay, do I have enough traction? We have to go back and think about, okay, I'm going to the market, I'm going to see people that I have never seen before. I have never, they don't know me, they don't know what I do, they perhaps don't know the space, they don't know what I'm capable of. I haven't shown them anything. I don't have numbers, I don't have customers. I have this brilliant idea and my enthusiasm, and I'm showing up and I'm asking them for money. Now, I want you to turn back on the other side of the table and say, okay, if you were to do a significant investment in your life with a complete stranger, what kind of measure do you need? What kind of comfort do you need before you can put actually your hand into your pocket? Mm. So if we start actually looking at the investors of not being just here to distribute the money for the sake of distributing the money, but being people that have emotions, and we're asking them to get into a very engaging relationship, I think we would approach the fundraising in a completely different way. And I think that mindset is very important to set, so that you can go to the market both at the right time and with the right level of preparation.
Interesting. Anusha?
I can just add to that, because I think, you know, somebody mentioned the word credibility a few minutes ago. Preparedness adds to that, because when you're coming in and you're fully well versed in your business and you are prepared to answer the questions beforehand, right? And a lot of the questions will be very similar. What's the size of the market? Where do you see this? Where do you see this going? How would you plan to go from A to B? What, how do you plan on, if it's a B2C business, how do you plan on customer acquisition? So if you're prepared to answer those questions, I think that adds a lot to that story, and that adds a lot to that engagement with the investors. And to Kareem's point, it makes it that much easier for someone to then reach into their pockets to invest. So I think preparedness goes hand in hand with the point around credibility.
So in terms of one particular point, which is the timing to start going to the market, I think it is counterproductive to go into the market when we are not ready. So if we are going to see a complete stranger and asking them money to invest in like an idea, the only people that can do that are your friends and people that have known you for a long period of time. We cannot go to see other investors with such a little. If you want to see people beyond your immediate circle to get and ask for money, then you need to do your homework. Part of this is to make sure that you understand very well the market. And one of the things that I've seen over and over again, and by the way, I've been also guilty of doing the same mistakes a couple of times, is thinking that I have enough understanding of the market and enough, I would say, enough insight into whether a product is going to work or not. So it takes quite a bit of time. It takes quite a bit of investigations by running a series of experiments to understand whether or not we have something that people would be ready to take on. And before having the validation that people are ready to take on whatever we have to propose and whatever solution we are putting in the market, at that point in time, we once we have proven this, we can go and see investors that don't know us and are looking at investing in new ventures, more than ideas, but ideas that have been already tested. So it is your job to make sure that your ideas are more than just ideas, but concepts that have enough evidence that this is something that is going to work with the right support and the right investment.
I think what's the other interesting thing is entrepreneurs have a beautiful enthusiasm for their own business. And I think, you don't find many entrepreneurs who are pessimistic about their own company's future growth potentials. And one of the things that I saw, particularly back in the UK, is a frustration from the investor side is when the growth projections were so ridiculous, and that it kind of undermined the credibility of them themselves. I think with all of these, you want to show that your business is going to grow and have an amazing potential, but actually, if you say, we're going to take over the world in 6 months, then actually that kind of undermines that point. So how do you find the balance between being optimistic but not seen as maybe foolish is the word? Anusha, do you have any thoughts on that?
I mean, for me, it's about making sure you have the right data to back it up, right? So if you're going to put projections and if you think that, and dissect the information from which way, right? If you're going to do revenue projections, break it down into its component parts. How many customers does that mean, right? Per unit price or whatever metric that you're using. If you find that your projections means that you're going to be servicing 120% of the population, then maybe you need to revisit it, right? So I think just cross-checking and having the right data to back up whatever you're projecting. And there'll be a lot of cases where new ideas particularly, right? It's not always easy to project, but at least have a basis for the assumptions that you're putting down. And I think that's important. Again, it goes back to doing your homework and being prepared.
And in your pitch deck, I mean, one of the other interesting questions we get a lot is about preparing your pitch deck for investment meetings, which were the last deck that you created, Anusha, which were the 2 slides that you think were the most important 2 slides in the deck of, let's say, 25 slides? What were the 2?
The first 2.
Interesting.
Nobody gets beyond that.
No, because I would say, what is the first one? Is the problem. What is the second one? Is the solution. If you cannot articulate well the problem and the solution, is usually you have something wrong. So so there's and usually you don't need more than 50 words, 30 words to be able to put this into the 2 slides. So if you cannot reach this with such level of clarity, then you need to continue doing your investigation on the market.
Yeah. So an interesting question from the group, from Matthew. Thank you very much. He says, how important is that an idea has traction locally in the UAE if you have mostly done outside work previously? So you may have customers in the EU or the US, but you don't have local traction. What is that something that funders here would have a problem with, or do they want to see local traction?
I think, I mean, in my opinion, you can probably, I think it's a good start if you have traction anywhere. There may be specific questions that you get asked with respect to how does that shift, and how does the shift in demographics impact the product? And I think if you can address that, then you're already quite a ways ahead, given the fact that you've proven that there is demand for the product in another geography. The follow-up question to that would be, well, keeping in mind the idiosyncrasies of this region, how does that impact the demand? And if you can answer that, then I think you're good ways ahead.
I think it's an interesting question, Matthew. There is one startup that come to my mind. If you have traction outside, why do you want to raise funds in the UAE? That's my question, right? And for that, I have in mind the startup that is called Schedule, which is like Fresha, right? It's like a booking app for spas, and they started here. The founders were living here. They started here. And actually, they realized that most of the traffic was coming elsewhere. The first thing they did is they took a flight, they went somewhere else, and they started raising funds elsewhere, which became a lot easier for them to raise funds here as well. So if you have traction outside, you should, I would ask you, why do you want to come here? Because then you can raise funds outside for international expansion in the UAE. That's one scenario. The other scenario is, if you have traction outside, and you want to raise funds in the UAE, which, I don't understand why you would do that, but let's assume that this is the case. You need to understand that you need to prove that these markets are going to be similar, because a product, the solution that you bring to the market is market specific, and it might be very applicable to US and European countries, but it might not be applicable for a UAE market, whether it's purposes, whether an example, open banking is, so you can have a solution that works there, you can have traction there, but open banking is not ready for the Middle East, and therefore you will not have traction in the Middle East. So again, is that there are good reasons for you not having tractions, and there are bad reasons, and it's very important to understand these before you decide to expand in a country.
And interesting, we have Astro Labs, we have quite a lot of companies who are looking to expand into the region. I think Dubai has an incredible opportunity. What is it, a third of the population within 3 hours, a third of the population of the world within a 3-hour flight. But the majority of those, like Kareem said, have raised funds in their own country and are using those funds to expand into the UAE rather than coming here and looking for funding. And again, if we just take a moment and look at the investors, the types of funding that's possible. Again, we are looking at the kind of lower end. We've mentioned a couple already: family offices, high net worth individuals. What are the other areas? And I'd love maybe for you, Kareem, just to talk a little bit about them and any kind of strategies, places to go? How do you find them if you were looking out? Is it, you need to find someone who's well networked and link into them? What would be your strategy for someone who's starting?
Look, as I mentioned earlier, step number one is I need to make sure that this is I have done enough in terms of understanding the market, the product, and the solution that I'm offering before going and seeing these people. And depending on the stage, you can go and see different type of investors. So it's important also to understand what type of investor does at what type of or at what point of evolution within the life cycle of a startup. So when you initially have an idea and you need some money, well, you need to use your own money and your family's money and your friends' money. And that should help you do the market assessments, do some prototype, MVP, and start talking to the first customers. Once you start talking to the first customers and you see that there is appetite and you have proven this more than once, at that point in time you can go and see angel investors for pre-seed. And basically an angel investor is somebody who has capital that is willing to invest. And in the region you have people that are sophisticated angel investors and non-sophisticated angel investors. So again, if you go and see sophisticated angel investors, you need to know how to talk to them and how you need to present things to them. If you go to non-sophisticated investors, then not only you need to be well averse on how to deal with your own things, but you also need to know how to educate that non-sophisticated, not sophisticated angel. And once you've started doing that again, you need to go into seed. And when you go to seed, you can start looking at accelerators. You can start at looking at more established VC funds that invest in seed. But the seed of today is not the seed of 10 years ago. The seed of today, back to Anusha's opening comment, is you need to have a business that start looking like a business and not an idea.
And just very quickly in terms of, and maybe easiest in US dollars, what do you see the friends and family, angel investors, and then the seed accelerators, roughly what are the kind of different ticket sizes that you would see on those ones?
The reality is, if you have a massive addressable market, you're going to have to go and raise more money up front. And because the opportunity is so massive and you have to raise a lot of money up front, the ticket size is not the same. Now, if I'm talking about, I would say, the typical industry standards when it come to, I would say, angel rounds. Angel rounds would be between 50K to 300K US. Pre-seed round would be between, I would say, 300 to a couple of millions. Series A would be a couple of millions to tens of millions, depending on the size, depending on the opportunity. So there is no real rule. It's a function of how big is the addressable market and how quickly you want to ramp up to go to address that market.
I think there's a really interesting point there. One of the things that so I had a startup back in the UK. Unfortunately, not as successful as I'd like it to be. But the knowing how much to ask for is also really important. I think too many funders, you say, look, we want to raise $1 million. Why? And actually having a clear strategy for what that $1 million, where does that get you? So in $1 million, this is where we want to be, and this is what we need for it. I think there's often a temptation to raise too much and then potentially lose a lot of your equity. Anusha, I thought one of the points I thought were really interesting was about the educating of investors. Did you find that when you were raising that there were certain investors that you had to almost upskill them before they were ready to invest?
Yeah, I think this is the same point that Kareem was was mentioning, right? There are sophisticated investors and they're not so sophisticated investors. So there's, for the unsophisticated investors, it's not just about convincing them about the idea, but then it's also about what will that structure look like and what will the terms be. And you could you just have to be careful not to go down a rabbit hole of sort of complicating the conversations too much, because I feel like it's actually harder to have the conversation with an unsophisticated investor, because you could be making a point that is very logical and maybe have been taken through industry practice, but they're like just refusing to even acknowledge that that's a relevant point. So from that perspective, I think I find the conversations when you have a sophisticated, even if it's an angel or a seed individual, if they've gone through that, if they've done it a couple of times before, they're usually easier conversations to be had, as opposed to starting from scratch, because then you're fighting two battles. Not only are you trying to convince them about your business and about the idea and about yourself as a team, but you're also trying to convince them about everything from the terms and how the deal should be structured. And it does become, and it takes a lot of time. I think people always underestimate, I certainly did when I was starting off, underestimate how much time and effort it takes to get people across the line.
And how long did it take you from start to finish in your last raise?
It took us but keep in mind, we got COVID in the middle of everything. So, so we started in January, we started getting good traction, Feb, March, but then everything dried up very quickly. A lot of the people we were talking to started looking inwardly about their own concerns, whether in their own portfolios or their own financial situations, etc. So that really dried up the conversations. We finally were able to close by July. So this was about a 7-month period for us.
Well, 7 months is a long time. And I think that's, I mean, as someone who's got a finance background, I think it's so important to know your runway, because I think, as you were kind of alluding to, if you start too late, then actually, you get to that position where you may run out of cash and you might have a fantastic idea that doesn't get off the ground because of that. So I think actually I think that's a really good lead indicator of actually, you might need at least 6 months to kind of close out funding. So you need to understand how your cash flows are going to get you through that period. Is that, and then in terms of time wise, and I suppose one of the most interesting ones is particularly people who are new to the region, is how do you build up and those networks, and how do you get those initial introductions for whether they be angels, family offices. I assume Googling is not the answer. So I'd love to hear, Kareem, your thoughts on actually the best ways of getting those introductions, assuming you've, like you said earlier, met all the criteria, you've got good traction, you're confident in yourself and your presentation, and you want to take that next step. How do you go about that?
I will give you an interesting answer. I think the founding of the investor is the most entrepreneurial aspect of the entrepreneurial venture, because it's like really, you can define a methodology, but in the end, luck plays a big role. You need to, it's essentially finding a buyer of. So if we flip just a little bit the vocabulary, and the reason why I would like us to sort of change the vocabulary, because it helps change the perspective. And if we decide to see funding as a sales activity, and if we decide to see this sales activity as a very complex and high-stake sales activity, we will understand that we will take things in a different way and approach. So here we have something that we want to sell that is not necessarily viable, and we need to go and find the right person and get this person, or this institution to buy out this thing that we have to sell. We have to be extremely convincing, and we have to touch emotionally the institution or the person that is going to make a decision to make that purchase. Okay, so it requires luck. It requires also a lot of follow-up. It requires a lot of perseverance. It requires a lot of networking. A lot of dedication, because you will get a lot of no's. You will get people that don't understand what you are trying to do. You're gonna get people that are gonna tell you, your thing is not gonna fly. And you have to. This is where the optimism of the entrepreneur needs to come into play. It's not so much about selling the world. It's about when people come and tell you no, to carry on, to continue to carry on. And it's very, very challenging mentally. So back to you, the first thing to do is there are databases where you can look at angel investors, pre-seed investors. You can do your diligence in understanding, okay, what kind of sector they are interested in. And then you need to reach out to people that have invested in those companies to talk to them, to ask for advice, to tell them, what they think about your idea, not necessarily go and say, okay, can you buy something from me? If you go in the street and ask somebody to buy something from you, they will tell you, no, sorry, I'm not interested. But if you go and see them and present them how this thing is going to help them and what they are interested, and then you can get to know them better, you increases your chance of selling that good that you are trying to put in the market. So it requires a lot of patience. It takes time. It takes preparation. It takes dedication and work and luck.
I think luck is an interesting one. I think, Anusha, as Kareem was talking, you were nodding along to lots of his points. Is that you have a similar experience?
Yeah, I mean, I think he used the word persistence as like there's no substitute for that. You just have to be able to get your story across to the people. Find connections. For us, like I said, we went through this period of fundraising where we would then, everything sort of slowed down because of the changes COVID was bringing. But what we did was we kept everybody who had shown any sort of interest, we kept giving them updates on the company, on the product development. We kept pushing, everything that we were up to, any sort of, even if it was a new merchant who was coming on, we just kept them informed. And that really helped, get sort of, one, you remain on top of mind, but two, it also showed them what was happening in the company, right? So when we were talking earlier about being prepared and educating the investor about who you are, that doesn't necessarily happen over one meeting. It happens over multiple engagements, and you have to constantly be engaged with the investor set that you feel is going to get across the line.
I think that's super interesting. I think, interestingly, there's an incredible advisor back in the UK called Ollie Barrett, and one of the things he always talked about was exactly that: bring them on the journey with you. To see your highs and your lows, whether it be the product launch, and actually, if you can get the investor to feel like, or potential investor to feel like they're on that journey with you, then it's much easier to kind of convince them to get across that line, that last bit. And actually, the bit of advice he would always give was breakfast mornings, bringing people in and inviting them for breakfast before work, because often people, they love a free breakfast, and it's not that expensive from a cost point of view, and actually you can really build up that trust, and sharing that story with people, I think, is a great way of crossing the line. Just want to bring in a question here from the audience. A question from Ola. Thank you very much for the question. Is it important to dedicate time to listen and find out why the investor wants to invest, and what they're interested in, other than just financial gain? So I suppose the question is, often investors, yes, they all want to make money, but there often is a secondary, or it may even be a primary reason for investors. And I think something that you said, Kareem, kind of linked into that, like speaking to other people they're invested in to find out a little bit more about them. How much work do you think needs to go in to understand all of an investor's incentives, whether they be financial and non-financial?
A very good question. If we go back to the sales analogy, if somebody is wanting to sell a complex product, they need to do their homework. They need to go to LinkedIn. If you do B2B complex sales, you need to do your LinkedIn. You need to look at what the organization is doing. You need to look at how it's being organized, who has the decision power, who has the budget, who has this, who has that. So there is a fair amount of diligence that you need to do in order for you to maximize your sales. So if the founders have a sales background, they understand that very well. For the technical founders, it's a bit more challenging, because the comfort zone is not to go out there and do the sale. But unfortunately, as a co-founder, as a founder of a company trying to raise funds, you become a super seller, and you need to basically sell your company to get people on board. So back to the point of how much diligence is needed. Well, it is critical to know what people are looking to do, because otherwise you are wasting your time. and you will just create frustration to you. So first of all, is I'd rather to max. So it's a game of probabilities. You're going to meet 100 people, and 95% are going to tell you I'm not interested, and maybe out of this 95, 80% are going to tell you, no, this is never going to fly. So you don't want to put yourself into, the hassle of, it's already difficult, and you want to make sure that you're making your life easier along the way. And this process takes also a lot of time, which is time that you cannot devote in going and seeing customers, fixing your buggy product, and so on and so forth, recruiting and getting your accounting right, and so on and so forth. So in order for you to do that diligence and talk, and you need to understand the investors. But once you understand the investors, you need to understand, if you go to see a fund, they have an investment strategy. You need to understand what that investment strategy is. To do that, you need to reach out to the fund before you have something to sell. And you need to assess what they've been doing. You need to talk to other co-founders. There are communities where you can talk to other people. And once you get to actually saying that, okay, this is the investment strategy of the fund, of the person, then you need to get into the personals and the emotions, because ultimately we are human beings, and we make decisions based on emotions. And studies have proven that when people are sort of their brain is inhibited when it comes to this emotional piece, they cannot make simple decisions. So emotions and decisions are going hand in hand. And you need to be able to click and seduce and get enthusiastic whomever is going to make a decision with it at institution that has a strict and rigid investment strategy.
And Kareem, I can't believe you missed the opportunity to name drop Astrolabs. You said you need to be part of a fantastic community.
Yes.
And then you should have said, like Astrolabs. Thank you very much.
Actually, I'm in Astrolabs. It doesn't look like it's in my background, but I am sitting in Astrolabs.
Yeah, and I think you're right. I think actually it's interesting. You could Google for 1,000 years and never find the answer. And actually, always we find that going into speaking to someone, having a coffee with someone, and saying, "Hey, what was your experience? Hey, how did you crack that egg?" Is really important. And actually, to a certain extent, finding the right investors for you, for where you are, for what you're doing, is exactly the problem. So, Anusha, how did you find the right investors for you? Like, what was your strategy?
Other than persistence and just keep hounding them. We did a lot of research on who is in the space. We did a lot of research in terms of who's been investing in, well, not just in the sector or the industry that we were looking to get into, but the ticket size that we were trying to raise, who was active in that. And then for a large number of them, we just literally found emails and sent them out. That was probably the least effective way, because very few people responded to just cold emails. We used our network to get introductions. I think that was probably the best way to actually get meetings, warm introductions, and whether it was through employees or friends. What we would generally do is we would go through LinkedIn and say, okay, is it a second connection, third connection? And reach out to that person and say, can you please, I know that you're in, so-and-so at this firm, can you introduce us? So I thought that sort of warm connect much easier, and to at least get an introductory phone call or get an introductory meeting. And then also before lockdown, just sort of getting to some of the conferences and getting to places where you would have investors congregate. So I think that was another thing, and it's become harder as with those conferences being far now. Well, some of them are coming back, but for the last 6-8 months they haven't been around. But that was a good way to also just meet people, because I think when you are in physically, so you drop somebody a cold email, they can ignore it. But at least if somebody you sit across the table from somebody, or if you're chase them down after they've had a speaking slot, then it's easier to connect with them.
Yeah, I think that connection is so important, and whether that warm introduction is through, it's so valuable because it instantly gives you a crack in the door that you still have to go through, but it's important. The question's come up a couple of times, so I'm asking for a fairly snappy answer. Are there any online resources to look up angel investors? Would there be any particular ones that you would recommend?
Yes. Magnet is one of them. That's actually, they have a comprehensive database, so you need to buy a subscription to it. You need to buy Sales Navigator in LinkedIn to work out and do your research with that. You have angel networks that publish things. This is not a substitute to go in and talking to people. Really, for me, the entrepreneurial journey is all about being out there. No matter what we do, we need to be out there because the information, the market is out there. So we need to be out there to capture as much information as possible to be able to make sense of it and decide the course of action.
Anything from you, Anusha, on that?
I mean, some of the local research, you get a lot of stuff from this Magnet. Mina Bytes does some stuff. Crunchbase was another one that we used. Again, it was just, finding out who's doing the deals, what's the space that they're operating in, and then trying to find out some way of getting in touch with them.
Yeah, I think Crunchbase was something that comes up quite regularly. I mean, particularly almost everyone will have one competitor unless you're really a groundbreaking startup into some new area. And just simply looking at who invested in your competitors gives you a good steer, at least in the right direction and in the right type of funders and in the different things. So we're going to move on to probably the $1 million question. Obviously, taking on a funder means that you have to give up something in exchange. And as much as we'd like people to invest for 0% equity, that is unlikely to be the case unless it's maybe your mum or dad. So, I mean, it's a massive question, and I don't want the answer to be, oh, it's too complicated or there's too many questions. But how do you decide A, how much you need to raise, and B, what you give away in terms of an equity percentage? There's a couple of questions we might get time to look at in terms of other alternative ways, whether it's through the convertible loan notes and other things, but we'll probably leave that only if we have time. So yeah, the first question around how do you work out how much to give away? Anusha, do you want to start?
So the critical question is how much you're going to raise. What is it going to be used for, right? I think you mentioned this yourself a little earlier. You end up raising too much. You could end up giving too much equity early on. So you have to be sensible with the amount that you raise. So obviously it's a mathematical equation, the amount you're raising and the valuation that you're going to raise it at, and that's how much you're going to effectively give up. Now, the amount you raise should be measured, and you should be quite comfortable that will give you enough cushion for your next phase or give you enough traction for your business. The valuation starts becoming a little bit more trickier, right? Because we are talking about seed businesses, we are talking about very early stage businesses, and that becomes, I think that's harder, I think, to pin down. There's also, so for us, I mean, I'll just tell you my own experience, and this may be the right thing or maybe it wasn't, but from my perspective, what we did was I said, I know what the business is worth. I know if I go out with X, investors are going to negotiate it anyway. But I also had a floor for myself. I said, this is how much I believe that I can, potentially give up. And so I sort of balanced it between that. I think having a realistic expectation of valuation backed by, again, measurements and proper metrics is one aspect. And then believing in having your own sort of sense of where that will come out or how much are you willing to give up. That's the sort of the balance that you need to play.
Interesting. Kareem?
Those decisions of how much money is needed and at what valuation are critical decisions in knowing how much dilution to give up at a given round. But at the same time, those are very complex finance questions. I mean, Anusha can navigate through this very easily because she used to be MD in a well-established private equity fund, and it's a second nature to her. But you know, I deal on an ongoing basis with founders that don't understand the revenue between cash and the difference between cash and revenue. So let alone understanding how much money is needed and how the dilution is going to proceed and what class of shares to use under what condition. These are like very, very complex topics that I mean, we definitely can give some guidance here. But I invite you know, founders to make sure that they have the right people around them, or they have the right support to help them navigate through this. So the mechanics is simple, but the judgment around the mechanics is what makes it complicated, and this is where you need experience. The mechanic says, okay, I'm going to build a business plan that gives me, based on what I currently know, because I have done my market research, this is what, you know, the business is going to look like in the next 18 months. There is no need to do 5-year business plan, and if somebody is asking you for a 5-year business plan, you can't tell them that they don't understand startups. So 18 months is already a big leap of faith to get a sense of, okay, you know, directionally how this is going to look like if I take on the cost. Now, the issue in this is that the costs tend to be heavily underestimated. And this is where you need a seasoned finance professional who has done this in the past to make sure that we baked in the right level of cost so that you don't end up into trouble. So once you know, usually it's going to be negative, so your revenue are never going to cover your costs. And you need to sustain this for 18 months. And you need to build this in a way where you have enough of a sexy business in 18 months so that people that are going to join the wagon in 18 months are going to do this in an easy way, right? So that's the mechanic. So at that point in time, you know how much money is needed. You know how the business is going to look like in 18 months. And the reason why I'm saying 18 months is because this is the typical runway, 14 to 18 months. This is the typical runway that you need from one round to another. That you come up with the amount of money that is needed. And then and then also the target that in 18 months gives you roughly an idea of what the valuation could be. And so you work backward and you say, okay, now I'm going to sell, shares in the company to get to that valuation point and with that amount of money. And you typically, you need to look at dilutions between 10 to 30%. Depending on the industry, depending on the traction, depending on your negotiation power, whether or not you are oversubscribed or not. But essentially, running these metrics, it's an art, and you need to make sure that it fits within a dilution between 10 to 30%.
It's interesting, the bit of advice that I was given around from a funder's perspective is they effectively want to take as a big as percentage as they can. They want to have as much of the company as they can. But if they take too big of a percentage, then the person who's doing it, the founder, loses some of their incentive, because if you only own 5% of a company, you're not going to do it with the same drive. And it's that from an investor's perspective, they see it as a balance between allowing the founder to have enough of the equity to drive their passion and commitment and 23-hour work days, 7 days a week, but at the same time trying to take as much as possible. And I think it's a question that comes up very, very often about what is the right percentage, what is the right valuation, and it's something that people much smarter than me have 3-month courses on at Harvard University on different ways of valuing businesses, and I think it is a tough one. And the simple answer is for every business it's slightly different. I think it's a tough one, and unfortunately there's no easy answer. So just conscious of time, we've got about 6 or 7 minutes left. I think I've covered most of the questions from the group. So I'm just having a quick look. I don't think there was anything that we missed. So I suppose just to kind of bring it to the end, I'd like both of you to answer just the same question. You have very kindly agreed to be a mentor to a startup, and you're in a meeting, and they say, "Hey, we want to raise money." What would be your kind of like 2 bits of advice that you would say that they would need to do? Maybe starting with you, Anusha.
Ooh. 2 bits, huh?
Or 1 or 3.
Well, that's like effectively summarizing this entire call, right? Be prepared.
Exactly. Easy.
I think one of the things that we actually haven't touched on, and I saw a question sort of pop up, and maybe I'll take your question and use the opportunity to answer that one as well, is the team and the people that are on board, right? And the specific question that had come was with respect to whether you need a technical founder or not. I think it's broader than that. I think it is important because part of what you're going to be convincing your investors of is that it's not just a great idea, but you have the ability to execute it. And that's where the team becomes extremely important. So whether you keep the tech in-house or whether you outsource it, I mean, at the end of the day, you have to be able to convince them that, and usually, we get this a lot from investors. You know, they prefer to have two founder teams, and having done the startup this year myself, I can see why, right? Because there is just so much to be done, and it is physically and mentally quite taxing to do it all on your own. So having the right team in place with the right skill set to be able to execute on whatever business plan you present on them is extremely important. And then letting the investors know who those people are and what their roles are going to be and how they're incentivized in the business, I think is also important. And it was just one of the things that we didn't really get a chance to come around to. But I think, you know, if you're getting ready for investor meetings, that's extremely important.
I completely agree. It's something that comes up so often. They talk about, you know, there's lots of waves we see, and it's always all about, you know, who is the team that's going to be able to harness that wave the best. So I think that's, you know, getting the right team is incredibly critical. Kareem, coming to you now.
My first advice is to really, I would say, to almost challenge them on whether they have a real solution for a real problem, because this is the beginning of everything, and it sounds so trivial, but you would be amazed by how many times I've seen solutions to problems that are not problems, or because just, you know, people wanted to build tech, and they've spent millions of dollars building this tech for something that really, you know, doesn't require that technology. Or so, and I get scared because it's such a taxing journey for the entrepreneur, for their family, for everybody around them, for their mental health. You know, there have been studies where entrepreneurs are like really, you know, are more prone to depression, etc., because of all of these ups and downs. So I'm usually very harsh with them in ensuring that they have a real problem to solve, and they have a real solution. Once I am convinced that they have a real problem to solve, and they have a real solution, I second Anusha by saying, okay, can they make it work? Because in the end, you have an idea, and an idea is great, but unless you know how to make it a reality, it's always going to stay an idea, and an idea is not worth much. So execution is key, and making sure that you can deliver on this is crucial. And third is, you know, and making sure that they are taking things one step at a time, very experimental in the market, making sure that they don't overspend, until they have something where they need to scale. Scaling up too early is a big temptation of so many entrepreneurs. And I think, you know, a wise entrepreneur is the one that knows when it needs to scale.
Super interesting. I just want to take a moment to thank you both. I think there was some incredible insights that you both raised. I have so many notes that I've scribbled down, and some really interesting points raised. I think we at Astrolabs want to bring together great people, because I think, you know, it's come up a lot. You need to surround yourself by good people. You need to have, you know, those coffees with people to help you grow. And I think it's super exciting. So thank you so much for both of your time. Thank you very much for everyone on the call. And my email address is at the start. If there's any questions that we haven't got to, if you want to reach out, please feel free to drop me an email. Otherwise, I look forward to seeing everyone sometime soon. Wishing you all the best for the festive season, and we will speak hopefully again soon. Thank you, everyone.
Thank you. Thank you, everyone, for listening. Thank you for your time.
Thank you.
Bye.